The call came through while a U.S. soybean-loaded cargo ship was making its way across the Pacific. At the same time, a quiet alert flashed on trading terminals in Singapore. China had just canceled all U.S. soybean orders, effective immediately. By midday, 2.4 million tons of soybeans were rerouted to Brazil. By nightfall, $1.1 billion in U.S. farm contracts were gone, just like that. This wasn't a trade disagreement. It was a planned takedown. And soybeans? They were just the spark that lit the fuse. 40 cargo ships were redirected, and a major billion-dollar trade corridor snapped, like a twig under too much pressure. This wasn't a mistake, it was a message. And it wasn't just farmers paying attention. Wall Street noticed. So did the Pentagon, because when your largest buyer cuts you off during delivery, without blinking, you're not in a trade spat. You're being tested. And it was the U.S. that buckled first. According to Bloomberg, China had suddenly canceled soybean orders from 3 top U.S. exporters, Cargill, ADM, and Bunge, citing strategic procurement shifts. Within the same week, Chinese firms had secured 2.4 million metric tons of soybeans from Brazil, worth over $1.1 billion. Have you subscribed yet? You won't want to miss our next upload. Thank you, and let's continue. Based on customs data reviewed by S&P Global, that single purchase made up nearly 1/3 of China's average monthly soybean intake. Beijing didn't officially call this retaliation. But the timing? It was just 48 hours after President Trump rolled out a new set of tariffs, $90 billion worth, on Chinese goods. Economists at Rabobank now warn that this may not be a temporary move. It could mark the beginning of a long-term effort to sever China's reliance on American agriculture. So, is this just a short-term reaction, or are we seeing a complete overhaul of global food trade patterns? On the ground in the U.S., the impact was immediate and obvious. The USDA's April 2025 soybean report showed a 13% jump in unsold domestic stockpiles, pushing storage to its highest April level since 2019. In Chicago, soybean spot prices dropped by 8.2% in a matter of days, wiping out $470 million in market value in just 1 week. In Iowa, the mood among farmers has turned bleak. We've been cut off mid-season with no backup plan, said Matt Dunn, a fourth-generation farmer from Des Moines, in a Wall Street Journal interview. This isn't just a trade disagreement anymore. This feels like economic exile. The American Soybean Association estimates that the Chinese market exit could lower U.S. farm incomes by as much as 18% this quarter alone. Now the bigger question, how much worse can it get? Trump's 20% tariff on Chinese electronics, metals, and EV parts, announced March 10th, was meant to pressure Beijing ahead of trade talks. Instead, China struck back where it counted: agriculture, one of the last U.S. exports they still depended on. And soybeans aren't just any crop. In 2024, the U.S. shipped $14.3 billion worth of soybeans to China, making it the biggest single item in U.S.-China trade. China is going after Trump's political base, rural voters and farming states, said Chad Bone, a senior fellow at the Peterson Institute, during a CNBC interview on April 2nd. According to the USDA, farmers across 11 Midwestern states now face moderate to high risk of insolvency due to canceled forward contracts. With the pressure rising, could this trade war turn into a major political risk for Trump? Let's pause. Not because the drama has eased, but because it has shifted. This isn't just about soybeans anymore, it's about geopolitical strategy. Brazil's ability to step in wasn't just good fortune, it was carefully planned. Between 2020 and 2024, Brazil increased its soybean farming area by 21%, backed by more than $11.2 billion in agricultural infrastructure upgrades. China's state-run development banks have been busy financing grain terminals in Santos, expanding freight corridors from Mato Grosso, and co-funding the Ferro-Grão Railway, slashing internal transport times by 42%, according to a February 2025 Reuters report. This infrastructure laid the foundation for China's strategic pivot. In fact, Bloomberg Intelligence now estimates that Brazil can meet 70% of China's yearly soybean needs. With fewer GMO rules, relaxed environmental restrictions, and stronger protections under BRICS trade agreements, Brazil's rise as a supplier may no longer be just a temporary shift. Is the U.S. being permanently edged out, not merely outpriced, but outmaneuvered? The timing of China's pivot wasn't random. It was precise. March through June has historically been the U.S. quote, most profitable window for soybean exports, generating nearly 40% of its yearly revenue based on USDA trade figures. China's withdrawal during this crucial period sparked a widespread sell-off, damaging both prices and export volumes. Even more striking, Brazil hadn't yet hit full harvest capacity. That means China knowingly paid premium prices, around $14 to $22 more per ton, as reported by traders speaking with the Financial Times. Why willingly overpay? According to Minyu, a trade analyst with China's Ministry of Commerce, accepting short-term losses is a way to gain long-term influence. So this move may not have been about soybeans, but about leverage. But leverage for what? Officially, China pointed to phytosanitary concerns, citing fungal residues and pesticide traces in recent U.S. soybean shipments. However, as of April 2025, no confirmed violations have been recorded by either the USDA or the WTO complaint system. While soybeans dominate the spotlight, corn is quietly slipping out the back door. Between January and March 2025, U.S. corn exports to China dropped 29% compared to the same period last year, according to the USDA's latest Foreign Agricultural Service report. At the same time, China locked in a 3-year corn import deal with Brazil's CONAB agency, allowing up to 9 million tons annually, worth around $2.66 billion. But this isn't an isolated move. In March, China's state grain reserves sold off 1.2 million tons of U.S. corn, citing unstable prices and a strategic shift in sourcing. Industry experts say the deeper issue is trust. After years of rising tariffs and politically driven export restrictions, Beijing now views U.S. agriculture as too risky. This isn't just diversification, it's insulation, said Joseph Glauber, former USDA chief economist, during a Wall Street Journal interview. This wasn't just a trade argument. It was a test run. China proved it could walk away from a $14 billion U.S. commodity and replace it within 72 hours. No delays, no shortages, no domestic backlash. So what happens when they apply the same playbook to semiconductors, to rare earth metals, to U.S. Treasury bonds? What happens when the next pivot isn't about soybeans, but about the dollar itself? That's not just a warning for farmers. It's a wake-up call for Wall Street and for Washington. Because if this was just phase 1, then what comes next? Stick around. If soybeans were only the trial run, the US dollar might be the real target. We hope you're enjoying the video. Don't forget to like and subscribe. Stay tuned for more hot news from 3 Daily News. Catch you in the next one. The soybean shock sent ripples far beyond American farms and Chinese ports. Experts warn that this was more than a blip. It could be a blueprint for how global trade wars reshape the world. Over the next decade, we could see a fundamental realignment in the way countries trade, secure food supplies, and form alliances. Some analysts predict a future where nations build self-sufficiency, investing in domestic agriculture and diversifying supply chains to avoid dependence on any single partner. This could mean more regional trade agreements and less reliance on global giants like the US and China. Food security may become a top priority, especially for countries caught in the crossfire of major power struggles. The World Food Program warns that sudden trade disruptions could threaten vulnerable populations, pushing governments to rethink everything from stockpiles to crop subsidies. Geopolitically, new alliances could emerge. Brazil, for example, is already forging closer ties with China, while other nations look to hedge their bets between East and West. The U.S. might double down on innovation and diplomacy, or risk losing its influence in key markets. The next decade will test the resilience of global systems. Will we see a fragmentation of trade blocs, or a new era of cooperation forged by the lessons of the soybean shock? One thing is certain, the world is watching and preparing for whatever comes next. Thanks for watching. For more deep dives into the forces shaping our world, make sure to subscribe and turn on notifications. Stay informed. Stay ahead.